everyone. Thank you so much for joining. I would like to give you a quick overview about interest-bearing versus non-interest-bearing debt instruments. It's quite important to differentiate different types of liabilities or debt instruments, especially for financial ratio analysis. So debt instruments in general can be classified into interest-bearing and non-interest-bearing, depending on whether they generate explicit interest expenses for the borrower. When we talk about interest-bearing, this is debt that requires periodic interest payments at a stated interest rate. Here, the borrower incurs interest expense and the lender receives interest income. For example, bonds, bank loans, other corporate bonds, debentures, and so on. Short-term revolving credit facilities, overdrafts, commercial papers, short-term bank loans. So these are all examples of interest-bearing debt. The impact on financial statements is they still appear as liabilities on the balance sheet. They generate interest expense, which affect net income on the income statement. And they also impact cash flows as interest payments reduce operating or financing cash flows. When we talk about non-interest bearing, they also exist for short-term debt instruments and long-term debt instruments. This is debt that does not require periodic interest payments, but may still have an implicit cost. The lender here does not receive interest income directly, but may benefit in other ways, discounts, extended payments terms. So there's no direct cash outflow, but there is some underlying implicit cost or income depending on the side. Examples here, when we look at long-term zero coupon bonds, bonds that are issued at a discount and repaid at face value. Short-term non-interest bearing liabilities would be trade payables, accounts payables, accrued expenses, deferred revenue. They are also reported as liabilities, but they don't have explicit interest expense, but have an implicit costs. Good. Main question here is how to handle them in financial statement analysis. As you may recall, when we looked at liquidity ratios and when we looked at solvency ratios, long-term focus, liquidity short-term focus, I would suggest for liquidity ratios, you consider both interest-bearing and non-interest-bearing liabilities. Because liquidity short-term really measures whether a company can meet its short-term obligations, and companies must repay both interest-bearing debt and non-interest-bearing liabilities. So because it has an effect on companies' short-term obligations, I would include both. Otherwise, some of your ratios, for example, current ratio, quick ratio, cash ratio, they may be under or overstated depending on how you see it. So I would say include both, because in the end, directly or indirectly, they require payment and need to be settled. But if you have a chance, for sure, prioritize interest-bearing short-term debt since it directly affects cash flow. When we look at long-term analysis, like solvency analysis, here I would say the primary focus should be interest-bearing debt, because here it's more about the ability to meet long-term financial obligations and avoid financial distress. And because those long-term interest-bearing debts, bonds, bank loans, they have regular interest payments. These are actually the instruments and the key drivers for financial risk. But again, if you have a chance to distinguish Non-interest-bearing long-term liabilities are also obligations, but usually do not cause immediate financial distress. So, yeah, proposal for solvency, focus on interest-bearing debt mainly. Some of the calculations for solvency we learned in another video: debt to equity, debt to EBITDA, interest coverage. And there, I think, especially in textbooks, you see many times focus on interest-bearing debt. Okay, but again, no right and wrong, just a hint or a suggestion from my side, because sometimes young professionals and students, they find it a bit challenging. Okay, which type of debt should I include and exclude? I think this is my proposal when looking at interest-bearing versus non-interest-bearing debt. And I hope you have also received some information. What is it all about? Thank you so much for listening. I see you in another video. Bye-bye.